It looks like the Federal Reserve Bank might finally be admitting that they might have been wrong about inflation. The Federal Reserve Bank Governor Christopher Wallace recently did an interview this week, and one of the things that he was talking about was, are the Federal Reserve Bank officials going to raise interest rates again in 2023? And what he said was, it depends, because we don't want to make the same mistakes we did in 2021. Let me read you what Christopher Wallace had to say. When it came to the topic of raising interest rates again, he says that it depends on the data. We have to wait and see if this inflation trend is continuing because we have been burned twice before. In 2021, we, the Federal Reserve Bank, saw inflation coming down and then it shot up. And then in the end of 2022, we saw inflation coming down and then it got revised away. So the Federal Reserve Bank now is trying to decide what to do with interest rates as a way to try to cool inflation. Remember, the Federal Reserve Bank is a central bank here in the United States. And the reason why they raise interest rates to cool inflation is because they want to cool demand. The price of anything in our economy depends on supply and demand. The more buyers than sellers that you have, the upward pressure that you have on prices. So for example, if you have 100 people that want to buy one home, that home is going to get a bunch of bids on that house, and then this home might sell for $100,000 over asking. Versus if you have 10 homes from sale and only one buyer who wants to buy one of these 10 homes, now the sellers would have to cut the prices of their homes to incentivize that buyer to buy their home. And what we've been seeing now for a number of years is we've been having a lot of demand in the economy. Meaning people want to buy clothes, people want to buy vacations, people want to buy homes, people want to buy cars. And to cool down this demand, to cool down inflation, the Federal Reserve Bank has been increasing interest rates because while the Federal Reserve Bank can't tell you not to go out and spend money, what they can do is they can make borrowing money more expensive. And so when they raise interest rates, it essentially makes borrowing money more expensive. Your credit card debt becomes more expensive, your mortgage becomes more expensive, buying a car with the car payment becomes more expensive. So borrowing money becomes more expensive when you increase interest rates. And so now, when you are a business, or if you're a person and you want to go out and spend money, now you have to look at the monthly payment twice. Because now what you thought was going to be an $800 monthly payment is now a $1,600 monthly payment. And now you have to decide, is this something that I can afford? And what that does is it cools down demand. And so now we're at a point where inflation is still around. It's still higher than where it should be or where the Federal Reserve Bank wants it to be. And now they're trying to decide if they want to continue raising interest rates or if they want to stop or take a pause. And the reason why this is important is because the Federal Reserve Bank understands the implications of raising interest rates too much. Because if you raise interest rates too much, too fast, you can throw the economy into a recession. Now, of course, the Federal Reserve Bank has come out recently and they no longer believe that we are going to enter a recession. They have said this publicly. However, they also understand that if they keep raising interest rates too quickly, that this could tip the United States into a recession. And this is where now the Federal Reserve Bank is trying to play this game. You have inflation and you have a recession. They want to cool down inflation without triggering a recession. But the question is, how much higher do you have to raise interest rates to make that to happen? And how can you do this in a way that you don't cause or create an environment where inflation can keep rising, because that means you have to be more aggressive with interest rates, which means a deeper recession. And this is what the Federal Reserve Bank actually said. What he said is that I don't think, quote, one more hike would necessarily throw the economy into a recession if we do feel that we needed to raise interest rates again. It's not obvious that we're in real danger of doing a lot of damage to the job market, even if we raise one more time. So we have the Federal Reserve Bank meeting on September 19th and September 20th. And the general economic consensus amongst investors and economists is that the Federal Reserve Bank is just going to pause. So the public opinion is that the Fed is going to pause in September, but then the Federal Reserve Bank meets again on October 31st and November 1st. And today, at the time of me recording this video, you have a lot more people who believe that the Federal Reserve Bank is going to raise interest rates again on October 31st and November 1st, that meeting. Now, the reason why this is so important to understand is because, well, you want to understand where interest rates are, where they're going, and their impacts on the economy, because, well, the Federal Reserve Bank doesn't believe that we're going to see any sort of economic pain. But you have to remember that raising interest rates causes a cool down in spending, and we have yet to feel the impacts of that. And if we do see a significant cool down in spending, that's going to cause more economic pain. And this is what we've been covering in Market Briefs. Market Briefs is my free financial newsletter. If you have not joined Market Briefs yet, it's a free and easy way for you to stay up to date on what's happening in things like the housing market, interest rates, the economy, the global economy, crypto, stocks. You can read it in less than 5 minutes every morning, and it's completely free. So if you have not joined Market Briefs yet, I got the link to how you can join down in the description below, or you can go to briefs.co/market. But the reason why this is so important to understand when it comes to interest rates is because everybody has an opinion about what's going to happen with mortgage rates, the economy. But one of the biggest factors here is interest rates. Because if you think about the economy and inflation on this teeter-totter, in the center is interest rates. And so if interest rates stay high, or if they continue to go higher, that's going to put more downward pressure on the economy. And when you look at things like mortgage rates, which mortgage rates are very high now compared to where they were 12 to 24 months ago, although they're not high historically, mortgage rates today are historically within normal levels. They're high compared to what they were 2 years ago. But then this is where you have people like the Mortgage Bankers Association and the National Association of Realtors saying, don't worry, mortgage rates are on their way down. They're going to be coming down very shortly. Yet we just keep seeing them going higher and higher. And the reason why, or one big reason why, has to do with the interest rates that the Federal Reserve Bank sets. And the reason why it's important for you to understand this is because if interest rates keep going higher, what does that mean? Well, that means less demand to buy a home. Because if mortgage rates go up, less people want to go out and buy a home. It means less demand to buy a car. It means less demand to go out and buy watches, which means realtors struggle more because you have less buyers out there. It means car salespeople struggle more because people aren't buying as many cars. It means watch salespeople are struggling more because they're not selling as many watches. And so that has an impact on the economy because then there's less goods being transacted. And if there's less goods being transacted, it means you have smaller profits per certain businesses, and you have certain people making less money. And if people are making less money, that means you have people buying less stuff. Because if I'm a realtor and I go from making $200,000 a year a couple of years ago to now $70,000 a year, well, I might have to adjust my lifestyle. Maybe I can't buy as many vacations. Maybe I can't buy as many clothes, which means you have less spending happening in the economy. And if you have less spending happening in the economy, that means other businesses make less money. Because our economy doesn't run in a little vacuum where the housing market doesn't impact the car market. It runs in this big ecosystem where each piece of our economic system is impacting one another. And now we've seen this huge run-up in prices across the board, from housing to cars, although car prices, especially used car prices, have started to come down. You have all this run-up in prices. And now consumers are looking at the prices of things saying, well, I'm going to have to make a decision about what I want to buy. And on top of that, you also have student loan payments restarting. I was meeting with this doctor friend of mine who's in residency right now, and he was considering going out and buying a new Tesla. But the reason why he's no longer buying a Tesla is because now he has to pay about $1,100 a month for his student loans. So instead of buying a Tesla, he decided to keep the car that he has right now for a little while longer. So we have this economic system that runs on spending. And if less people are buying, say, Teslas because they have to go back to their student loans, well, that impacts the economy, not just for Tesla, but also now for the Tesla employees. Well, that means Tesla makes less money. If Tesla makes less money, maybe that means they can't keep as many employees. Or that means the Tesla shareholders make less money. If the Tesla shareholders make less money, that means people have less money to spend in other places. Again, our economy is one big ecosystem where each piece of the economy touches the other. And this is why you want to pay attention to interest rates. And this is why you want to pay attention to what the Federal Reserve Bank is doing. Now, of course, interest rates are just one piece of the economy. It's not the entire economic system, and by itself, it cannot determine where the economy grows. You can see the economy grow even though interest rates are rising. You've seen this happen a few times in the past. However, that is the exception, not the rule. Most of the time, statistically, when you see interest rates rise quickly, you see an economic slowdown happen. Out of the last 14 rate hiking economic cycles we have seen, we have seen a recession happen 11 out of those 14 times. 3 out of the 14 times you did not see a recession. So yes, you can see the economy grow even when you're seeing interest rates rise, but that's more of the exception, not the rule. Most of the time when you see interest rates rise, it causes a slowdown in the economy. And we have seen interest rates rise very aggressively in the last 18 months. In fact, this is one of the most aggressive rate hiking cycles since the early 1980s. So will we see more economic pain? Well, our economy goes through cycles. We always see booms and busts. But just understand we have a lot of money that has entered our economic system. And we have a lot of factors that are influencing our economy, from inflation to interest rates. And this is where it is so important for you to understand what's going on, but pay attention to things like the Federal Reserve Bank, pay attention to interest rates, because this is going to have an impact on what direction the economy is going to grow and go, and how that's going to impact the job market, because our job market is also going through its own kind of craziness right now, which I covered earlier this week. So if you haven't seen that video, go check that out. But this is where it's so important to understand this, because you don't want to be one of the people that just believes that everything is always going to be sunshine and rainbows. You want to be prepared for anything, even though that means you might have to wait a little while. But being prepared allows you to protect yourself and capitalize on new opportunities that might come your way.